What if you invested $100,000 in Fidelity and another $100,000 in Vanguard, the two titans of index investing? Same amount, same year, same strategy. 10 years later, one of those investments quietly pulled ahead, earning thousands more, while the other lagged behind. These aren't meme stocks, day trades, or risky bets. We're talking about the core of long-term wealth building, index funds, where millions of investors park their life savings. But here's the question: if both Fidelity and Vanguard track the same indexes, how can one make you more money than the other? Fees, tracking error, dividend reinvestment, or maybe something deeper about how each company manages its funds? Today, we're putting these two giants head-to-head in a real-world showdown. We'll see how $100,000 performs in each, how much you'd have today, and, most importantly, which one is actually the better choice for your money. So before you invest another dollar in an index fund, let's find out. Fidelity versus Vanguard. Which one really wins the $100,000 test? To understand why this comparison matters, you need to know one thing. Fidelity and Vanguard aren't just investment companies. They represent two different philosophies of how ordinary people can build wealth. Vanguard is the pioneer. Founded by Jack Bogle, it practically invented the concept of the index fund, a simple idea that changed everything. Instead of trying to beat the market, you simply own it. Fidelity, on the other hand, started as a traditional active management firm, focused on stock picking and research. But over time, it evolved. And today, Fidelity's index funds have become some of the most competitive in the world, even challenging Vanguard's dominance. Both firms now manage trillions of dollars, serving millions of investors who want the same thing: steady, long-term growth without the stress of market timing or individual stock picking. But here's the surprising part. Even though both claim to track the same indexes, like the S&P 500 or the total market, their results aren't identical. Over a decade, small differences in expense ratios, tracking efficiency, and dividend policies can quietly compound into thousands of dollars. So, if you were to start from the same point, investing $100,000 in each, which company's index fund would leave you with more money today? That's what we're going to uncover step by step. We'll break down the data, look at performance charts, and explain why the results differ, because understanding this could literally change how you invest for the rest of your life. Let's dive deeper into the numbers, because that's where the truth hides. When people hear Fidelity versus Vanguard, they often assume the returns must be identical. After all, both track the S&P 500, right? But the secret of investing is that small differences in fees, structure, and reinvestment timing can quietly reshape your wealth over time. Let's start with the basics. Vanguard's VFIAX, the Vanguard 500 Index Fund Admiral Shares, was launched in 2000, though its predecessor goes back to the 1970s, one of the oldest and most trusted index funds in existence. It's built to mirror the S&P 500 almost perfectly, holding shares in the same weightings as the index itself. Fidelity's FXAIX, the Fidelity 500 Index Fund, is newer, but fiercely competitive. It does the same thing: track the S&P 500, matching the performance of the biggest companies in America. On paper, both funds should grow at nearly the same rate. If the S&P 500 gains 10%, both should be very close to that figure. But now let's look under the hood. Vanguard charges an expense ratio of 0.04%, meaning you pay $40 per year for every $100,000 invested. Fidelity undercuts that with 0.015%, just $15 per year. That difference sounds tiny, but imagine you keep that money invested for 30 years. Those small savings compound, potentially adding thousands of dollars to your balance simply because your fees were lower. Over the last decade, Fidelity's FXAIX has averaged an annual return of around 12.8%, while Vanguard's VFIAX has delivered roughly 12.7%. A tenth of a percent difference per year doesn't sound like much, but over $100,000 and 10 years, it's about $4,000 more in your pocket. Over 20 years, it could exceed $10,000. That's the quiet power of compounding. Every fraction of a percent matters. Now, some investors argue that Fidelity's edge comes mostly from its lower fees, not from superior fund management, and that's true. Both firms use full replication, meaning they buy all 500 stocks in the S&P 500 in the same proportions. But how they handle things like cash flows, dividend reinvestment, and capital gains can create tiny deviations called tracking errors. Historically, Vanguard has been the gold standard for minimizing tracking error. Its scale and structure allow it to match the index with near-perfect accuracy. But in the last 5 years, Fidelity's systems have become incredibly efficient, sometimes even outperforming the index slightly, likely due to internal cost optimizations. Another area where they differ is how dividends are handled. Both funds automatically reinvest dividends, but not at the same moment. Fidelity reinvests on the payable date, meaning your money gets back to work immediately. Vanguard usually reinvests 1 or 2 days later. Over a decade, those small timing differences, especially in a rising market, can compound into real money. It's like getting 1 or 2 extra days of compounding each quarter. Then there's structure, something most investors overlook. Vanguard is unique because it's owned by its funds, which in turn are owned by the investors. There are no external shareholders demanding profits. That structure aligns its incentives entirely with the people who invest through it. The company's mission isn't to maximize its own profits, it's to minimize your costs. Fidelity, meanwhile, is privately owned by the Johnson family and runs as a for-profit corporation. But don't mistake that for greed. This competition has actually benefited investors. Fidelity has been the one constantly pushing fees lower, sometimes forcing Vanguard to follow. And Fidelity has something else Vanguard doesn't: a deep investment in technology and user experience. Its online platform is faster, more modern, and offers better integration with research tools and retirement calculators. Vanguard's website, by contrast, feels minimalist, functional, but dated. It's designed for long-term investors who log in once a quarter, not traders checking prices every day. Still, Vanguard's simplicity has its strengths. For many investors, it represents discipline, a reminder not to check the market too often, not to chase the next big thing, just to stay invested and let time do the work. Fidelity, on the other hand, can appeal to those who enjoy having more control and data at their fingertips. If we step back and compare beyond the S&P 500, both companies also offer total market index funds, international options, and bond funds, and the story is similar. Fidelity's expense ratios are often a few basis points lower, while Vanguard's performance is nearly identical but backed by its mutual ownership philosophy. Let's think long-term. Suppose you invest $100,000 today, add $500 every month, and let it grow for 25 years with an average 8% annual return. With Fidelity's slightly lower fees, you might end up with about $512,000, compared to $508,000 with Vanguard. The difference, around $4,000, isn't huge, but it's real. And it illustrates a deeper truth. Choosing between these two giants isn't about chasing the winner. It's about discipline, consistency, and minimizing drag. Both Fidelity and Vanguard give you access to the most powerful wealth-building tool ever created: the stock market itself. The key isn't which one is better. The key is simply to choose one, stay invested, and never let emotions drive your decisions. Whether you prefer Fidelity's innovation or Vanguard's philosophy, both paths lead to the same destination: financial freedom through simplicity. Because at the end of the day, your wealth won't be decided by which company you choose, but by whether you had the patience to stay the course when everyone else was chasing the next big thing. So, Fidelity or Vanguard? The truth is, both are excellent choices for long-term investors. Fidelity wins slightly on costs and accessibility, while Vanguard still holds the crown for its investor-owned structure and long-term trust. The best option for you depends on your goals, your discipline, and how you plan to grow that $100,000 over time. If you learned something valuable today, take a second to like this video. It helps the channel reach more people who want to make smarter financial decisions. And I'd love to hear from you. Which fund do you trust more with your money, Fidelity or Vanguard? Leave your thoughts in the comments below. I read every single one. Finally, if you want more in-depth videos breaking down investing strategies, financial psychology, and real long-term wealth building, make sure to subscribe and turn on notifications, because the next video might just change the way you invest forever.